We continue our series of Meet the Manager videos today as we're joined by Robin Parbrook from Schroders. Robin, thanks so much for joining us. Robin is the co-portfolio manager on both the open-ended Schroder ISF Asian Total Return Fund and also the London-listed Schroder Asia Total Return Investment Company. Robin, I thought to kick off, the strategy is pretty differentiated against a number of the peers in the Asia space. I wondered if you could maybe just run us through the approach you take to investing in Asian markets.
Great. Well, nice to be here. Thank you for allowing us the time to talk to you. The fund does take a reasonably different approach. And what we always say, going back to the fund's been going almost 10 years now, so going back to when we first started with the fund, the universe in Asia, or the benchmarks, and most people use the MSCI, AC Asia, ex-Japan benchmark, doesn't represent why you'd want to invest in Asia. It's very heavily weighted in state-owned enterprises, Chinese banks, quite heavily weighted in cyclicals, a lot of materials and energy, some of which are of fairly questionable quality. That's not what you really want to buy when you want to buy Asia. You want to buy the best Asian domestic consumer companies that will play off rising wealth and prosperity in the region. And also you want to buy those best Asian export companies, the Samsung Electronics, the TSMCs, those cutting-edge companies that are predominantly actually in the technology space. So when we launched the fund, we said we want to buy a fund that really just buys the reason you want to invest in Asia, buy the really good quality companies. So forget the index. We're not interested in the index at all. We're only aiming to buy 40 or 50 of the best businesses in Asia. We have our research team at Schroders. We have 25 analysts, 35 analysts including Australia, 12 fund managers. So what King Free, who co-manages the fund with me, does is we spend our time working with the team to get the 45 best ideas in the fund. We never buy state-owned enterprises, or hardly ever buy state-owned enterprises, and really just focus on those companies that we see as the long-term growth companies in Asia. The second part of the fund that differentiates, I think, us from some of the competitors is, Asia's prone to big swings. It's a volatile region. For a lot of people, Asia's a more tactical rather than strategic asset class. So it means you get hot money flowing in and out. And in Asia itself, I've spent most of my career working in Asia. You see high levels of retail participation, and retail investors obviously tend to buy when markets are frothy and things are good, and similarly sell on when things look bad and you get the panics, which means you get a much more volatile asset class in Asian equities than you would in UK equities. So what you want is a fund manager when you're getting those volatile swings that isn't afraid to take money off the table as the markets move up to 2 standard deviations expensive, so which broadly speaking in Asia tends to be when you get close to 2.5 times price to book, 20, 25 times earnings. They take their money off the table either by buying more defensive stocks, raising a bit of cash, or in our case, we also use index futures and options to take market risk off the table. So the aim for us is to buy the best businesses in Asia, obviously at the right price, and then by using the flexibility for futures and options or raising cash to provide a better risk-adjusted profile. So broadly speaking, since the fund's been going, it's almost exactly 10 years now, the fund has done quite well versus the index, but actually what we're more pleased to see, it's actually done it in a much less volatile manner.
Okay, so perhaps we'll cover the what is a fairly concentrated long-only portfolio shortly. But perhaps firstly, the hedging strategy. Could you maybe run us through the factors that go into leading that hedging strategy, and also perhaps what your current outlook on the region is?
Yeah, I mean, good question. So the fund at the moment is running with a small amount of cash. We're only about 96% invested. So we're still finding enough stock ideas to keep us fully invested. Asian markets are veering towards expensive at this point. Only 40% of stocks our analysts cover. We cover about 800 stocks in the region. Only 40% have upside to our fair values. Long-term average for that year is about 55, 60. At extreme market events when markets are overvalued, it tends to get below 30. So we're looking at a point where the markets are expensive, but we're definitely not in a bubble. So enough to say we're happy to not raise cash to be fully invested. On the hedging overlays, it's interesting at the current point. We have 2 sets of hedging overlays in the fund. One that looks at long-term using mean reversion and the Campbell and Schiller work that markets do mean revert to standard valuation metrics over the long term. Those models have started turning cautious. They're still forecasting upside for the bigger Asian markets, so Australia, Hong Kong and China. But for the rest of the Asian markets, it's forecasting very limited returns, or in some cases, negative returns. So where we're seeing negative returns, we're either looking to reduce our stock exposure or selling index futures where we have stocks. So just gradually at the moment, and that's quite a big change from 6 months ago when we still saw quite good upside for Asian markets. So Asian markets are up 35% year to date. The second set of models are ones we use, what we call our tactical models, which we use a series of different indicators, mostly based around measures of financial distress, economic momentum or economic surprise, inflationary expectations, and a little bit on valuations to say, at this point, given what these indicators are reading, how have markets done historically? Those models are tactical ones, looking at 3 to 6 months, are still forecasting market upside. So as we all know, measures of financial distress are low. Economic momentum actually, or surprises, have generally been positive. So it's still saying, despite relatively elevated valuations, we still see more upside in the market. So those models mean that it's keeping us, it's actually saying to us, don't get too cautious on markets. But what the models are also saying, if you do see a pullback, historically, when we've had these kind of market conditions, they can be quite significant. So what we're doing in that side at the moment is buying a little bit of protection for the fund via puts, so using options on the bigger Asian indices. So it leaves the fund around about 70% net long at the moment, or which would mean, if one wanted to use more in terms of beta, the fund's probably got a beta about 0.7, 0.8. So if markets were to correct, obviously nothing is guaranteed, we should hopefully see an element of capital preservation, but we would still fall, but hopefully only about 70 or 80% of the market levels would fall.
So given that approach, can you maybe run us through how you go about constructing the portfolio?
Yeah, so there's two big features in the portfolio at the moment. We have about 50% of the fund is in technology and internet stocks. That's obviously been very helpful for performance over this year, and we're still reasonably comfortable with our tech hardware companies, so that's companies like Samsung and TSMC. However, the internet stocks in China, we have started to take a little bit of money off the table. It feels like a lot of good news is in the prices there, and those are where we gradually just want to start trimming positions. There is the risk, I think, as we look out medium term, that we will see more regulation in the internet sector, because whether it's the US internet companies or China internet companies, these companies are monopoly gatherers and users of our data, which that is the risk going forward. We don't see that discounted in market prices, in fact, far from it. So I'm not saying we're panicking and getting too bearish, but time to take a little bit of money off the table there. The other side of the fund, which I think is one that raises quite a few eyebrows for clients. So historically, we've always been quite rude and negative on China, and particularly Chinese banks and Chinese state-owned enterprises, or SOEs. We haven't changed our view, particularly on banks and Chinese SOEs. President Xi, I always say, has made my life a little bit easier. He's reaffirmed the fact after the 19th Party Congress, we're not going to see any SOE reform, and that banks are one of the ways he wants to control the economy. However, what he's also done is effectively closed the capital account. So Chinese FX reserves are rising again, the currency stabilized, so the immediate risk of a financial crisis has basically, in our view, gone. However, when you then look at China, ignore all the SOEs and ignore the politics, look at what's happening on the ground in China at the best private sector companies. You're really seeing the best private sector companies in China improving the quality of their goods. And I would say if you're number one in an industry in China, you're probably going to be number one globally, because China is the world's second largest economy, will probably be the largest economy in the world by 2020. Most industries have economies of scale. So if you're number one in China, you're going to have economies of scale. And now means, if you went back 10 years ago, we all used to joke that Chinese product quality was rubbish. And you'd look at industries, there's 65 players, and you couldn't tell who was going to be the winner. Now, when you look at a lot of industries in China, you can see they've consolidated pretty rapidly. Capital's quite scarce for private sector companies in China. You're actually paying a proper cost of capital. So the smaller, weaker players are getting squeezed out. So the example I always use of companies that should probably demonstrate, one of the companies that demonstrates its best in China is a company called Midea. Not a particularly well-known company outside China, but is actually the world's largest white goods manufacturer. So it makes fridges, washing machines, dishwashers. Number one in China, or number one, number two with Haier, which is almost about the same size in China. Those two companies now are starting to dominate those respective segments in China. If you got their showroom, Midea's showroom in Shenzhen, is just across the border in Hong Kong. You go and look at the showroom, the latest fridges, freezers they have are as good as anything you'll see in the West. In fact, Midea makes fridges and freezers for a lot of OEM brands in the West. So the quality is good. And where they've been taking market share in China is both from foreign brands, so they've been taking market share from the Hotpoints, and well, Hotpoints not sold in China, but the General Electrics, the Bosches and Siemens, and they've been taking a lot of market share from the smaller local brands. What does that mean? They're now getting the economies of scale. They have a huge R&D team. Their manufacturing is increasingly automated. Automating manufacturing, you need to have large amounts of capital and skills to do, but once you've got it all set up, you get better quality end product and at lower prices. You also have the distribution power to sell your equipment more widely. Net result is you look at the margins on Midea from 10 years ago where they weren't making much money at all, they're now making a 10% EBIT margin, very good return on invested capital. So I think that's just kind of one example, but we're also seeing that in companies like Hikvision, which does security cameras, companies like Haitian, which makes injection molding machines. Those two companies are both number one globally in their respective sectors because they've improved their product quality, had the economies of scale from being number one in China. The car industry is quite interesting. It's probably where the white goods industry was 5 years ago. You can start to now tell which of the local Chinese car brands will be successful. Great Wall, Geely, BYD. And if you look at the latest surveys and the latest cars they're producing, they're pretty much as good as Hyundai's, General Motors and Renault cars. So they are coming. You will be able to buy them in the UK in 3 to 5 years, and it will be a lot cheaper probably than a Renault and a Peugeot. So there's quite a lot of interesting things happening in China. The quid pro quo for that, and that goes back to talking about Midea, as I mentioned, they're automating a lot of their production. So 5 years ago when we were wandering around China, you'd go and see the manufacturing companies, they were all worried about not having enough workers because of the one-child policy. The workforce in China is now shrinking. They were all talking about, do we move our production to Indonesia, to Mexico, Vietnam? Now when we go to China, everyone just talks about automation. And that's a huge change. And the big sea change there has been the cost of automation has dropped off a cliff. The cost of buying robots, the cost of the microprocessors, the vision technologies and robots have dropped really, really dramatically. And the trend we now see in China is rather than the factories to leave China, is to actually automate. And that creates a bit of a headwind for the rest of the emerging market countries in Asia. So it doesn't affect Korea, Taiwan, Singapore, Hong Kong, but for your ASEAN countries, Thailand, Indonesia, Philippines, and in particular India, where you've got growing workforces, and the economic theory was going to be that as manufacturing and low-end services left China, that would move to lower labour cost countries in Asia, and that would allow them to grow their consumers and develop an emerging middle class. I think we have to call that into question. It will still happen, but it may happen much more gradually than we thought 10 years ago when we launched the fund. So that's left us actually feeling quite cautious on the ASEAN domestic economies and domestic names in those economies, and in particular in India, where we've substantially reduced the fund's exposure in India, mostly because of valuations. The market's gone up and earnings have been disappointed. But we look at the trends we're seeing in disruption and automation, and it doesn't look particularly favourable in our view that the theory Indian bulls will tell you the Indian economy is going to grow at 7 to 9%. Our view is the Indian economy is much more likely to grow at 5 to 6% as it currently stands today.
Very interesting views as always, Robin. Thanks very much for joining us. If you'd like any further details on either the open-ended or London-listed strategy, then please contact your investment manager for a copy of our recent research notes. Thanks very much.